Okay, good morning and welcome to another episode of the Crypto Hour. Today, in particular, we be looking at what's been happening in this past few days. The debt ceiling crisis. Another one. Sorry, I just had a coming back of the YouTube to me. So what I was saying today, we talk about again, we start with the macroeconomic situation, what's really happening right now with kind of interest rates. We had some big announcements this week. What's happening with the kind of debt ceiling crisis looming in the US? Will the US run out of money? Will they manage to agree a way forward and so on? So we look at all of that because obviously that then has an influence on everything else. Okay, so let me start sharing the screen, and we start with the news of what was going on in the past few days. So let's have a look at the calendar. Move this stuff away and filter. Okay, so this is kind of the shortened calendar with just the important announcement that we had this week. Okay, so as you can see, we had first of all the announcement of the interest rates announcement in the Australian dollar, and then we had a little surprise because everybody was expecting them to keep the rates as they were at 3.6%. There was an increase of 25 basis points to 3.85%. So as you can expect, that has created a jump in the value of the Australian dollar. I'll just show you very quickly so that you can have a look here on the chart. So this is the moment of the announcement, okay? So, and this is what happens when there are some unexpected news, is the market immediately prices the new reality in the exchange rate. And then, as you can see, the rest of the time, we've had a kind of like the market with them was digesting the news before last night it started actually moving higher. Okay, but this is kind of the effect, why these things are important, why these news are important, and to keep an eye on it if you are involved in any of the things that we what the announcements are. So that was a surprise regarding to the Australian dollar. The other thing, and where what the markets look at, apart from the numbers themselves, they look at the governors that talk about these, their outlook for the future. So again, we've had it here after a few hours after the interest rate rise in Australia. We had the governor of the Bank of Australia saying that coming out with a more hawkish posture in the sense that they're thinking and say, well, the inflation is not under control yet, so we might need to increase rate again in the future. And this is what then determines the outlook for a particular currency, because then if there is an expectation of rates going higher, then people may want to hold on to that currency because they think, well, we're going to get more for our money, and selling instead currency that are not expected to go up. You're going to think, well, probably the next move is going to be down rather than up. And this is, in broad terms, really what's been happening between the Australian dollar and the US dollar. Okay. Another big announcement that's coming today is the yearly announcement of non-farm employment change in the US. So that's kind of like a snapshot on the American employment situation and broadly speaking on the American economy. So this is a number again that will have a big effect on all types of markets, both currencies, commodities, crypto, everything then reacts quite strongly to this announcement, especially if there is a quite large difference between the expectation and the actual numbers. So the other big announcement this week, apart from, this is kind of a minor job opening announcement on Tuesday, it showed that the American economy maybe is not as buoyant as it was thought, had less job openings that they were expecting. But again, it was the announcement of the interest rate, the federal funds rate in the US, which was increased as expected by 25 basis point. But this is the important thing, okay? The statement, the monetary committee statement, okay? Because in that committee, what wasn't present, which has been for the past year or so, is an expectation of further rate rises. Okay, so the expectations is that with rates at 5.25%, that would be enough to then keep inflation under control and the economy still in a positive with a positive outlook. And we'll have a look in a moment of what this can mean. If this is likely, first of all, to happen, and then what it can mean for the economy, what follows then a pause in the interest rate hike cycle. Okay, we've had then on Thursday again, so we look at this for the Bank of Australia, the US, and then for the euro as well. We had again an interest rate rise of 0.25%, going from 3.5 to 3.75, which again was expected. But at the same time, it was quite dovish as well for the euro. So it has an opposite effect on the euro. So it pushed the euro down rather than up. Okay, and today we'll be waiting for this announcement of non-farm employment change. Now, if I take you to to some images. Can you see this my screen with the debt ceiling graph? Yeah.
Yes,
okay. And what we can see, just make it a little bit bigger. So, oh no, maybe. Okay, doesn't matter. If you can see here, this is the debt ceiling. So the budget, the debt, this ceiling is delimited by law. Okay. So at the moment, when this was produced, it was expected to be broken. So basically, the US is kind of projected to run out of cash by late July. The latest figures instead show us that this will be, because they had really bad tax revenues in the US recently, and this is expected to be hit in June, just only about next month. Okay, so what does it mean? This by the way is nothing new. Okay, is the debt ceiling has been raised 78 times in the past. So it's not something that is kind of like a disaster waiting to happen. It's happened before. Okay, so what happens generally when a debt ceiling is reached? And there are several possibilities, but generally speaking, the president and the House of Representatives and the Senate, they get together and decide what to do. So generally speaking, the result is that they decide to increase the ceiling to a higher limit. Okay. Now that obviously is not a process that happens seamlessly, because we have a Democrat as president, and we have the House of Representatives, which is controlled by the Republicans. So there is going to be some heavyweight negotiations going on before they decide to raise this ceiling. They could decide to leave it as it is, in which case pretty much the US administration would come to a halt in mid-June. Okay, and sometimes this has happened for a few days or for a small period of time, but then obviously the political pressure is enormous, and generally speaking, it does get increased. The other possibility would be that the US then, because they wouldn't have any more money to pay to service their debt, they could default on that debt. Again, that is kind of like unthinkable, because it would start a cascade of a domino effect that would make the Great Depression look like a sweet shop that closed down. So this is not very likely. What's the most likely option would be that they would just agree for a temporary raise there, and just basically to kick the can down the line for a few more months or a year. But it still is something that is kind of like will have an effect on the markets in general. And as we're seeing, we're getting to levels that are kind of like unprecedented, and levels of which, in terms of percentage of GDP, no country has managed to get back from in the past. And in 51 cases out of 52 has caused a default in other countries. Obviously, they were in the US. The only exception to this, as I've told you as well before, is Japan. But Japan is also a special case. It's kind of they had to then get some really draconian measures to be able to carry on, and they're not working very well either. So the Japanese economy has been pretty much standing still almost for the past 20 years. Okay. So what's likely to happen now? This is in the past. So you can see going from the early 90s. So the orange line is the kind of what is called the sticky inflation. Okay, the one that's very difficult to bring down, and the blue line is the interest rates. So how expensive or how cheap the interest rates are in the US. So you'll see, generally speaking, there has been a good reaction every time that the interest rates have been raised, and that has had a positive effect on inflation, on inflation, bringing inflation down, obviously, because everything is more expensive. So people spend less, and then inflation goes down because they need to raise lower prices to to get people to buy stuff and so on, until then their interest rates are lowered, and then the effect of a prolonged period of low interest rates is that the inflation starts climbing again. So the moment we have then raised the fund rates, now this is an old graph. Now it's 5.25%. So we're up here now. At the we are the same peak that we had in the early noughties, and the interest rates have started coming down. If this decline is would be enough with the current level of interest rates or not, remains to be seen. Okay, so this is what we'll have to watch. And I've told you, for the past year, the most important figure of them all at the moment is inflation, and that determines their policy, on and everything else. But so if you combine high inflation with a very high level of debt, very high level of a budget deficit, that causes not quite a few problems, but many problems. So this is another graph that we got from Bloomberg, which shows you the what happens normally when we hit the the top of a hiking cycle. Okay, as you can see, then what follows generally, there is a plateau for a few months that goes from, it could be from a few months to to up to quite a few, and then the next move is down, and the interest rate starts going down to a mean, to the average. Okay, the only thing is that what will that be, and what will be the new normal? At the moment is a discussion that that we can all have, but we are unlikely to go back to the 0% interest rates that we had before. We're more likely to go from the actual 5.5% to about 3% and stay there for a prolonged period of time. So this is what kind of the expectations of the markets are. Now, having seen this, what do you think? How do you think the market would react to the idea, and this is kind of pretty much accepted wisdom at the moment, and the expectation are that the Fed will not increase interest rates anymore. So what do you think? How do you think the market would react to that, positively or negatively? Anybody want to hazard a guess? Yeah, positively.
Positively. Yeah.
Okay, so that's the expectation. Generally, you're thinking, okay, there's going to be a nice reaction in the market, and that would be positive, because what markets don't like is uncertainty. So having kind of like a certainty, they're thinking, okay, it's not gonna our business costs are not going to go up, but they're going to be around this figure, and then they will get better. So if we can survive now at this level and make even a small profit at this level, then things will only get better for us. Okay, so we expect, and just bring you back to a graph. Okay, so this is the S&P 500. Okay, this is a kind of like a long-term chart, so it's a weekly chart. So what happened this week then? Why do we have a red week? And again, this is on Monday. This is Wednesday when the announcement was. We had a kind of like a big drop day. Tuesday and Wednesday, a big drop day. And now we establish actually a formation that tells us that probably this is kind of like a supply formation. So we expect it to, the market is supposed, if it does get back up there, then it is expected to give up again. So what happens? Why do we have this when we expecting to have kind of like good news? So markets should react positively to at least this kind of news. I mean, the Nasdaq has been marginally stronger, but not by much. To be honest, still the the Nasdaq as well has come down rather than up. Okay, so if we look at, sorry, let me just remove drawings. If we go back and look at a long-term graph, so we go on to the monthly graph. Yeah, you can see that we have almost like an unprecedented level of. Sorry, this is not. I need to go to a different chart. Sorry, just give me a second. This doesn't go back long enough. Okay. Okay. So as you can see, we had some really strong moves, followed by, so we had, as you can see here, from 1998 to 2000, there was a period of quite strong growth. At the same time, what did we have after that? A big drop. Again, we had the same thing in 2008, and we've had the same thing in 2020. So what kind of our expectation for the future from where we are right now? And this is my next image. Okay, so if you can see now the S&P 500 performance from the mid-90s to today's, to kind of like this was before 2020, but we have had a kind of like a 250% growth from about 94, 95 to the 2000, followed by a 50% drop. And then early 2000s to 2008, again, another 100% growth and a 57% drop. Now, from 2008, really from the end of that crisis to before the pandemic, we've had a 342% rise, which is kind of like enormous, and with rates of growth being well above 10% every year. Okay, so what is the expectation? So let's have a look at a more updated one. So if this ends in kind of 2019. Let's have a look at where are we now. So this is updated to the current date. Okay, so let me just go, so then we can measure. Right. Oops, sorry, let me just do a little bit of coloring to make it prettier for you. So this is this is the growth phase, and then we have a very, very sharp drop. So literally speaking, so this is kind of like an exception rather than the rule because of what happened to the market. We've had almost like unprecedented growth for almost like 14 years. Okay, so and kind of like almost like if you ignore the 2020 drop, would be like 600% in 14 years. Okay, but even if you just look at this growth here from 2020, it was 122% in a very short period of time. So if we go to what we had before, how long do you think we would have to drop to just do what's happened in the past already? Because we are due a correction. At the moment, the correction has been 26%. Okay, sorry, not 26%. If we look at this whole move, okay, so this is 624%. Okay, so out of, let me move that back. All right, just a second. Okay, so so far we have gone back, as far as 30%, but the 50% mark would be kind of like very far away from where we are right now. So we are at the moment at 4,100. We're talking about 2,700 to just go back to what happened before, and I bring you to the graph that we had before, where we happened in this period before, where it's normal to have a period of growth followed by a correction by another period of growth, because the things don't go up in a straight line, they go up in cycles. Okay, so that would be down to the 2,700 mark. And if instead we just look at this latest period, just close that off. If instead we just look at this, looking at if we consider this correction to have taken, to be a correction deep enough to have corrected all this period of growth, we already have pretty much reached the 50%, reached the 50% mark. So, so what is more likely? I ask you. It's more likely that we do have a deep correction here, or is it more likely that from here we have another leg up, knowing what you know about the economy? Anybody would like to try and guess, or at least guess what I think?
Well, I guess it's going up.
And I say correction.
Okay, so we have
deep correction.
Okay, so another deep. So we have 2 votes for a deep correction and 1 vote for instead a happy days. Happy days. Erica, that's a lot of
mostly in the text mostly has written correction, Lucas. So it's more people are thinking about correction.
Okay, more people think about correction. And the reality is that it will depend on the actions taken by the government. Okay, and how they react to the kind of the quandary that they're in. What a lot of people that look at fundamentals actually are thinking right now is that because no politician like to take the hard decisions, most of the time they just keep doing whatever they're doing already in the past. But the only difference is now that the situation is changed dramatically from what it was in 2008 and before in the early 2000s. They are talking. Everybody's talking now, for example, about central bank digital currencies, and even establishing like a new electronic token worth $1 trillion. Imagine that. But the reality is that if they were to take a step like that in the actual condition, that would start a domino effect, really, that would really cause the collapse of the US dollar in a record period of time. At the moment, what they are likely to do is just to do what they've done before, which is, again, start easing, start printing more money. And the result of it will be, that they will not be able to control inflation. So, they either go for a period of kind of austerity, where everybody's situation is bad because things are being tightened and the situation is hard and nobody's got any money, or they're going to the opposite thing, where everybody's got more money in their pocket, but they can buy less with it. And it seems to be kind of like from the political point of view, it seemed to be a less painful situation than actually physically taking money off people's pockets with higher taxes and with reduced spending, because that would be felt immediately by the electorate that would push the ruling party into losing the next elections. So politically speaking, what's most politicians will want to do is just to give things away to their electors, show that they are things are good under their under their stewardship. Okay, so my expectations is that we will probably over the next few years we will see normalize inflation going back to high levels, high single, and maybe into double figures again, until they can agree to a kind of a worldwide solution. Because this is not something that can be changed simply by replacing the dollar with something else. Okay, because inflation at the moment is a worldwide problem. Is not a US related only. So I think the only ways that they can keep the existing monetary system going is to devalue what it's out there, because obviously this system they are created, it's impossible to ever repay all the debt that has been created. So the only other solution, if either one thing gives or another thing gives. So if the debt will not give and keep growing, they make it worth less. Okay, by making the money, lose value. Okay, so that's my kind of like expectation. And also because by printing more money, they can give everybody the illusion that things are going well, because you were earning whatever $50,000 one year, the year after you earning 53, 54, you're happy. The only thing is that after a while you realize, yes, I'm earning more, but I actually buy less things with it, because my food costs like 50% more, and buying a car costs $10,000 more, and so on. But at the same time, the initial reaction is that is a positive. I've got more money in my pocket, even if that money is worth less. So,
Luca,
yeah,
just on this, surely won't this affect like the old age pensioners and those that are obviously on low salaries, because obviously those people that have next to nothing now, or are moving into that pension age, surely they can't earn obviously the increases that you're talking about.
Oh, definitely, and the problem is deeper than that, because as I was showing you last week, as the population is getting older, who's paying for these for the pension, for the money, for the social security, and for these things? Because these things there aren't funds put aside for these things. These things are paid by the workers. So if there are as a proportion, less workers to the total population as a percentage, that means it puts more pressure onto the population that is working compared to the one that isn't. And so the idea would be, yes, these things will be under pressure. As we've seen here in the UK, a lot of, who's actually had to bear the blunt of this pressure in the past 10 years has been the public sector. So not just pensioners, but also, public employees. And we see now there's like strikes everywhere because I mean, the latest one was the nurses, for example. They've gone on for 10 years with pay rises below inflation, which now puts them in a situation where people are working and they can't afford to work as a nurse and sustain a family, because they don't earn enough to actually, everything else has gone up in price, and while their pay hasn't. So that's a situation that's already in place, it already exists, and it will bring to social unrest. It will come to social unrest because it's obviously, if you don't have food to put on the table, you will do something extraordinary to make sure that you do. So you will go onto the streets and protest onto the streets, and you will go, we see with the kind of like refugee crisis that we've had in Europe, over the past 10 years or so, people have no options in their countries. They will just get on anything, risk everything to get on a rickety boat and just go across the water somewhere where they could actually have a job and just earn a living. Anything is better than dying and being bombed or dying of hunger or anything like this. And while this was something that we could watch from a window before, from an industrialized world, we could see as like a third world problem. Well, now this has become a first world problem, because you would see there is actual real poverty now. That's something that wasn't there 10 years, 15, 20 years ago. Real poverty in the richest countries in the world. So people, they are struggling. They either just don't have enough to live on, or they're living on the breadline. And this has become the norm, to the point where they come out in the UK, the Bank of England, they say, well, people have to accept that now they are poorer. Well, easier said than done. Easier said than done when you have been used to a certain standard of living, and then you have to, cut your cloth accordingly. It's not an easy thing to accept for a whole country. And there would be some pushbacks, because people want to say, well, it's you, kind of like you in terms of the ruling party, who have caused my standard of living to go down. And they will try to put somebody else in power that gives them what they want. And this is why the demagogues are going to power. This is how the Donald Trump and the Boris Johnson and the far right in Italy, Hungary, and other countries is becoming more and more popular. Exactly for this reason, because when people are unhappy, they kick out. Obviously, I mean, you would do the same, to be honest. If you didn't have, enough money to feed your family, you would go and do everything you can to be able to do it. So it's not surprising. What is surprising is that it is in in the US, in the UK, in Europe, in countries that are considered rich in terms of world population, and this is becoming a real problem, real problem. And I personally, I don't see a way of getting out of this elegantly. So I personally think that something has got to break to then reset and start again, like it did in the 30s, like, in many cases where there have been a financial crisis, there is kind of like a reset, and then things start going again. And we haven't got to that stage yet, that there will be something breaking. Where is that? Kind of like a couple of things. The other, now, another thing that you might have noticed, we're carrying on with the banking problem. Okay, so we have been telling you that the regional banks in the US were the ones more at risk. Okay, first of all, because they're not as deeply capitalized as the big banks, but also because they heavily exposed to the commercial property sector in the US, which is in crisis. Okay, as you can know, after the pandemic, a lot of people now work from home. A lot of office buildings now are half full, and a lot of now loans to finance those buildings are being renegotiated at a much higher rate, because there were loans that were taken at pretty much almost like zero interest rates, 10 years ago. Now, when those loans will need to be renegotiated, will be negotiated at 3, 4, 5%, which will cause many projects to be unprofitable at the current level. Okay, so the banks that finance those kind of projects are now in a crisis themselves. And we had, this week we had another two banks hitting the wall. And this is just being the beginning of it. What they're talking about here is the insurance, the banking insurance that were used to the insurance fund that were used to bail out, to pay depositors for example, Silvergate Bank, and with all the crises that we had recently, and now they want to get big banks to refill this insurance fund. And again, we'll see if the banking sector keeps going down, will that be enough to shore up the banking sector? Because at the moment, the answer from the regulators has been, don't worry, we guarantee your deposits, so you don't need to do a run on the banks. But there isn't enough money in the world to, if the banking sector was to actually crash in a serious manner, there isn't enough there to cover everything, and definitely not the insurance fund. So we'll see how that pans out in the next few weeks. But do remember about the regional banking sector in the US, and we've seen like 3 go down, kind of like last time, and now another 2, and there will be more. There will be more going to the wall. And what many people think is that the thing that is going to break could either be the banking sector, or it could be the other big elephant in the room, which is the derivatives market. Because if you think that the stock market is big, the bond market is much bigger than the stock market, and the derivatives market is much bigger than the bond market. So that's that's the real thing where the dominoes could start falling. So this is a situation for the economic banking, and what kind of where we could go in the next few weeks and months. But remember that the expectations now are, at least from a cash point of view, is that there won't be any more increases in interest rates. So kind of like expect in at least a bounce from the from the stock markets, and then at least from that kind of news, then we will see what other structural problems will come around the corner. But at the moment, at least it's a positive news that the pause in interest rate. From the point of view of Bitcoin, so we go back to that, to the Bitcoin chart, and as you can see, is these are the kind of like ranges that I highlighted to you last time. Okay, this is from May. This is the one that we had in kind of January till March, and this is the one where we've been now since 17th of March to till now. You can see we're still trading within that range, right in the middle in the range. Yeah. So this was we had a drop on Monday, and then Tuesday, actually Wednesday, was a positive reaction, because obviously if the dollar goes down, then things that are denominated in dollars go up. So in this case, Bitcoin goes up. It will, if I show you the some of the metals as well are gone up dramatically as well. But as you can see, Bitcoin is kind of like locked between this range between 30 and 27,000. You know, it's been in this range for, say, pretty much for a month and a half now. Okay, so remember the two options are, you know, we at some stage this range is going to break, and so where the direction in which it breaks, it probably this, you know, decide what the next leg is. Is it a leg down? Is it a leg up? Okay, if it's a leg up, as I said to you before, once we break and start trading above the 32,000 mark, then very quickly we'll move to the next range, which is up here. Okay, 37 to 42. Okay, so for some reason, you know, Bitcoin likes, you know, just remember one thing: if you are active in the markets, just remember that institutions trade in round numbers. Okay, they're not interested at, you know, buying or selling at 27,700. They go, okay, I don't know. For example, this range means that the message is, okay, if it gets, this is what the instructions to a trader between inside of a big institution. The instruction will be, you know, if it gets below 27, buy. If it gets above 30, sell. Okay, so these are the kind of things that they do. So this is why price matters, and you'll see that all these kind of like ranges are around $4,000, $4,500 in range, where the kind of institutions actually make the price range, and then for a while they just like get fat on fees and buying low and selling high and repeating the game a few times until they exhausted the gullible people gaining their money and not making enough, and then they think that they need some more excitement, and in that case then they move the price to the next range. Okay, so that's the other thing that to be expected. Now just a few things, and then we'll take some questions. This is why you got to be careful sometimes, you know, buying or selling things that are kind of not at very active projects, like Dogecoin, for example. Well, now there's an address with over 1.5 million Dogecoin that just re-emerge after being dormant for over 9 years. Now, obviously, Dogecoin, there's a lot more Dogecoin in the market than that, but you know, when you have something like this and you don't know who holds big chunks of coins in a particular project, it's very easy for a large amount of coins like this to be dumped onto the market and then to completely crash the price. So, and just one of the things that you should look at is when you decide if to get into a project or not, you know, who are the players that own big chunks of the coins of that project? Because especially when is a project that is supported by venture capitalists, obviously venture capitalists will have a plan to cash out at a certain point once they make their money. Okay, so you don't want to be caught on the other side of that. So you either buy things where they cannot be influenced because you know that the ownership is completely diffused, you know, like big projects like maybe Bitcoin, Ethereum, Cardano, and so on. Or if you're into smaller projects, be very careful in not necessarily talking about Doge, but I'm talking about many other crypto projects as well. Be careful about what you get yourself into, because you could get into a moment, you know, you might think that something is going up, for example, and you need to buy it, and then you might face yourself with a big wave of VC selling, because now they think that they reached their target and they want to cash out and put their money somewhere else. On a positive note about crypto, this is a Cash App. I don't know how many of you know Cash App or use it, but this is something by Jack Dorsey, which is obviously the ex-owner of Twitter. And so he launched a Block and the Cash App, you know, as a payment solution. And what he's saying is that Cash App is actually increased 25% year-on-year increase on Bitcoin revenue. So they are transacting a lot more Bitcoin than they were before. So Jack Up, Cash App is an app like, you might use, I don't know, PayPal or something else. So they are making a lot more money now from Bitcoin than they were making before. So this is it's a good thing, because it means that there are more people now buying and selling Bitcoin. So the use cases are getting bigger and bigger, and there are more of these things circulating. So it's becoming more of a more normal. More people are more used to transacting in cryptocurrencies than they were before. So it's a good sign of diffusion and use of more people using cryptocurrency than before. And here it's actually not such a good news about crypto. Okay. So this article is talking about centralized exchanges like Bitcoin, like Binance, like Kraken, like Coinbase, that are recording a dip in trading volumes on their app. Now, and this is on centralized exchanges, as I say. Okay, so what is due to? Most people think that, especially the one on Binance, has been because since they stopped doing fee-free trading on Binance, and so most of the traffic apparently was kind of like non-fee paying traffic. So now the volume has gone down quite a lot. But the thing that is worrying is not so much that, because you're thinking, okay, if central exchanges are going down, do decentralized exchanges go up instead in traffic, because the traffic goes from one place to another? Instead, what we see from DeFi Llama is that the traffic is actually gone down in decentralized exchanges as well. Okay, so and this is, we can all guess why this is happening, but most of it, would be just, if you just read that sentence, is a negative sentiment pervades. So how many bad news and have you heard about in the press, especially coming from the US, about crypto trying to debank a lot of crypto projects, actually literally closing their bank accounts, and even not so much crypto project, but even the owners of crypto projects are being debanked. So there is a really concerted effort to shut crypto down in the US. And obviously this has an effect, because many people now are scared of dipping their toes in the water, so to speak. So just remember that, all of a sudden, over the past 6 months or so, crypto has become a riskier place to be. Okay, so and so in a way, it's, from one point of view, one decision that you might have to stop sharing now. One decision you might want to ask yourself is it the right thing for me? Number one. And number two is, okay, if there is more risk that it's involved into any of these things, I might want to have more rewards as a result, because with more risk, unless you have more reward, then, you might think, okay, I'd rather go somewhere else where it's, a safer form of investment, if this has become riskier and I don't have any increased level of reward. So it's what I would say, I'm not saying one thing or another. That I am very into crypto, so I'm quite happy to carry on investing in the sector, because I am pretty sure that even if it was completely banned in the US, crypto will flourish in other parts of the world, because the benefits that are there for the users are improving users' lives. So from that point of view, I'm quite happy to for things to carry on. But there is no doubt that it has become a riskier place to be. So do bear that in mind. If you are investing in this space, and make sure that your risk control is forefront in your mind. Okay, this is really not a time to just put all your money out there and just wait to see what happens. I think you need to be a lot more discerning. Okay, so get informed, get educated, and keep your involvement to tried and tested projects rather than going for the moonshots. Okay, let's see some questions from Pierre. More and more banks are failing. How safe is your money in the bank? Not at all for me. For me, it's not at all. In the sense that, I mean, if depending on how much money you have as well, in a certain way, the banks will need to, the regulators will need to keep the insurance system going, because they don't want people to start queuing at the bank to get their money out, because there isn't enough money out there and will quickly run out. So for small amounts within the deposit insurance schemes, it's okay. Anything beyond that, it's very risky at the moment, I would say. Who pays the price when the derivatives market crashes? We all do, because that would mean literally, if the derivative market crash, we're looking at the bank sector would crash and burn, and we will go through something, really where we're all queuing up at the corner of the street to try and get some food. So that's the situation. It's not a pretty picture. Okay, it's not a pretty picture. We have built a castle card that at the moment there is no happy way out of it. So something will need to break. Is how bad. So the only question for me will not be if it breaks or not. It will break. Maybe, in a year, maybe in 5 years, maybe in 10 years, but it will break. Is how bad it will get when it does, and how quickly we will recover. That's the question, and how will we recover? So that's my question. But it's not something that anybody wants to see, because we live. Just think about it this way: we live in a leveraged society. Okay. So, literally speaking, our society is living on borrowed money. Okay, so if we need the result of any crisis, any big crisis like derivatives market, for example, would be a deleveraging. When thinking, because if you are if you can't trust credit anymore, you want real payment in something real for whatever you have of value. Okay, so if you have apples and somebody else wants to buy those apples for you, and there's a crisis, would you then be happy to accept to somebody to pay you on credit? I don't think so. You will want either cash if cash is still meaningful, or you will want some other form of hard currency, whether it's gold, whether it's barter with something else. We're talking about that. So what will come out of a crash? It's up for you, for all of us to decide, but I don't think it's something that the authorities could easily manage. So, it could mean the only thing I can see is like a big crash and then just going back again to a hard currency system. But it would need a different life for many of us. So many of us will need to go without the things that we've been used to. So let me see another question from Pierre. So if you take your money out of the banks and put in a stable coin, well, the stable coins are not safe either, because the money of the stable coins is in the banks. So it's not actually having a money in a stable coin. But the question is, and if you have a lot of money that you don't need, how do you keep that money in something that, if things go tragically wrong, you could still have access to? So yes, fine, and gold will still have a value, for example. Housing. So if you, instead of having lots of money in the bank, you buy yourself a house, for example, that house will still have a value because somebody will want to live in it. So these are all things that kind of like a different thinking of what if everything goes wrong, what would be left that will still be valuable. And it's not, obviously, we're talking about money is money. Stablecoin is still based on the current money system. So there is no difference really between USDT and the US dollar. So if the US dollar was to fail, then USDT will go down with it. It's then, rather than that, I would rather have money in a algorithmic stablecoin, if you want to give it in crypto, that gets its value not by dollar deposits, but by owning other cryptocurrencies. They are variable at a variable rate. So that would be my thing. How will bank crisis lead to food crisis? It's very easy. If you can't use your card anymore and you have to use cash, how much cash do you think there is in the world? And would you have cash to be able to buy anything at the shops? So if you can buy, there might be food in the shops that you're not able to buy. And that's that's the riots in the streets, really. Yeah, Helen, mainstream people teaching others to live off the grid and grow their own food. Sure, that's the way. That's the way that the only way something you can be sure that there is enough food for you to eat in in the long term. But what Paul is saying here in the last question, the value of cash is devalued. Yeah, fair enough. So, and this is what we've been talking about it, because everything is the value. We still have the cash to buy stuff, but it's worth less. So now instead of paying, I don't know, $1 to buy an apple, it will cost you $3 to buy an apple, and so on. So these are the options that we have. Not any of them easy, but I think this is what we're going to see. The only question is to, how quickly will the people in power realize that there's no way back, and they will think about, okay, what do we do now? Because I say at the moment, all I've seen is basically could be described as more of the same. Okay, so this is what I'm seeing right now. I'll leave you. Hopefully we have a light weekend, a lovely weekend, and without worrying about this. Okay, think about something else. Think about the coronation. Okay, we can all watch an old guy putting on some silly stuff, and everybody just like queuing up and just like blowing UK flags in the streets. Okay, I won't be doing that. Thank you very much. But if that floats your boat, feel free. Okay, and I remind everybody, Jonathan, if you could post your thing. There we are. Jonathan has a Q&A, Cardano Q&A that starts at 9:30. So I would recommend everybody to click on the link and go on to and listen to his session as well. So you can just have it as part of your routine on a Friday. You come and listen to the Crypto Hour first, and then you do the Cardano Q&A with Jonathan afterwards. So, and in the middle, you see, we've done it on purpose, haven't we, Jonathan? So in the middle, you have half an hour to go to the toilet, make yourself a cup of tea, whatever, and you are ready and set. And your brain is unscrambled from me talking for an hour, and you're ready to listen to Jonathan. Okay, so wish you all a great weekend. I'll see you all next week. And Chad, if you could stay on the call so we can have a chat. And for everybody else, I will see you next week.
Thank you very much, Luca.
Thanks, everyone. Luca.
Bye.
Thanks,
Bye,
guys.
everyone.
Luca.
Bye,
Thanks,
everyone. Bye.
Thanks, Luca. Bye.
Bye.
Luca, can you please cancel me?
Yep, I can do that.
Thank you. Bye.
Not often people ask you to do that.
Okay, just a second. I need to stop the YouTube. Hi, Logan. And the stream. Okay. Okay.
Yeah.
Done.
Hello, Luca.